So our first story of the evening is obviously over the course of the past few weeks, we have witnessed an epic market meltdown. And there has virtually not been a single asset class that has been spared from the selling, with circuit breakers getting tripped day in and day out. It seems like only one thing has been missing, until now at least, the implosion of a massive fund. Now, the Chicago-based Ronin Capital got margin called and forced to liquidate early today, marking the first major victim of the economic fallout that we're currently experiencing. CNBC broke the news today that one of the CME's direct clearing firms was unable to meet its capital requirements this morning, forcing the Chicago Mercantile Exchange to step in and invoke its emergency protocols to auction off the firm's portfolio. Now, Ronin Capital, their website does describe it as a firm that seeks the best and brightest traders and capital managers to embrace the firm's culture. Apparently, the culture that they try to foster does not include being able to manage your risk exposure. Apparently, that was left out of their training seminar. Now, CME's group chairman and CEO is Terry Duffy. He spoke to CNBC about this and the auctioning process, stated that they had completed it as of Friday afternoon, but they were not able to disclose who assumed the portfolios in the auction. Now, unlike a previous high-profile disaster on the Chicago Mercantile Exchange, which occurred back in 2011 when MF Global went bankrupt, that sunk customer funds along with it. The Ronin Capital implosion does not seem to have harmed anyone, any outside clients, as they only handled trades, they only cleared trades for the Chicago Mercantile Exchange itself. The chairman of the CE did clarify that with the clearing agreement that they made, Ronin is not allowed to have outside clients. So there weren't customers harmed in the process, which is a good thing. Good thing. Now, as far as what was behind the collapse, well, the CME Group raised margins twice this week alone. In the mini S&P 500 futures markets and the ESs, as of last week, margin was at 7,700, and by the middle of the week, it was raised to 9,900. And finally, late last night, they raised it again to $13,200 per contract, with Ronin finally unable to meet the margin calls. Now, CNBC broke the story, talked about how Ronin's downfall stemmed from the positions that it held in futures, which was tied to the VIX, the SIBO Volatility Index. Or put another way, it's a security that tracks market volatility. It's been very popular to trade with traditional market traders and futures traders, and it's unclear what exactly led to the margin call inducing stops getting hit. But there is word of an odd move in the VIX this morning, which may have tipped the scales against Ronin. Now, the auction, which liquidated their capital, was managed by the Trust, the Clearing Corporation. It's also known as the DTCC, who end of day confirmed that they were done liquidating. But again, they didn't reveal any details as to who assumed the firm's liabilities, their portfolio. Now, the great irony being pointed out here is how Ronin Capital's website has an about section, which talks about how much of their success derives from their superior risk management experience and their unique approach to sophisticated quantitative analysis with years of proven trading experience. Well, it seems that they can forget such grand claims. Instead, Ronin's legacy will forever be one of catastrophic risk management, and as the first victim of the 2020 financial crisis. And this just goes to show you that just because they got nice suits, and just because they work in a big office does not mean they know what's going on. When this kind of volatility comes into the market, you got to know how to keep your head on you. And even the big funds are going to take a big hit because they've taken big bets. They're all leveraged to the hilt. And this is exactly why I am advising traders here to do the exact opposite. Reduce risk in highly volatile times. Reduce risk in highly volatile times. And the way that we as retail traders reduce our risk is with position sizing, right? Lower position sizes in highly volatile markets. Protect yourself or end up like Ronin Capital.